San Antonio's apartment market has lagged behind the other big Texas metros for a few years now. Can the market close the gap in 2015? Welcome to Apartment Market Dynamics from MPF Research. I'm Jay Parsons. He's Greg Willett. And we've hit Houston, Dallas-Fort Worth, and Austin. And today we conclude our Tour of Texas video series with a look at San Antonio. And Greg, we've begun each of these discussions with a look at the energy sector, in particular with the decline in oil prices and what that means for the Texas economy. So let's start that off for San Antonio as well. How does it shape up in that regard?
Well, as we've said 3 out of the 4 times, there's pretty much no energy employment in this metro. If there's any impact in San Antonio, maybe it would come from the tourism sector, which is certainly big there. Households in the oil patch markets maybe not visiting San Antonio the way they would have previously. On the other hand, San Antonio is actually a big tourism market for the country as a whole, and lower gas prices are supposedly help the other economies, so maybe tourists from other parts of the country make up for the ones that you wouldn't get in Texas. Might be a wash there. One more observation on San Antonio's economic outlook. If you look at the apartment market, some softness in the last couple of years seemed to be in the middle to bottom end of the market. And frankly, there just seem to be some missing households. One theory would be, in fact, that those households are out working in the oil fields. If they lose their jobs there, come back to San Antonio and get jobs, there actually might be some upside potential from all that. So again, not a big oil influence. That means that we think that the overall employment growth number for San Antonio in 2015 really mimics 2014's number. Over the past year, 29,000 jobs gained, expanding by 3.2%. And again, 2015, virtually identical.
And let's look at some apartment stats. Apartment demand during 2014 proved okay at 5,169 units. That was just behind the 6,303 units that completed. And with that difference yielded an occupancy dip of 10 basis points, we are already at a low point in occupancy. So the metro ended 2014 with an occupancy figure of just 92.7, which was one of the weaker rates nationally. And effective rent growth for new leases is running at 2.4% year over year. Not terrible, but certainly not especially good either, especially when compared to some of the other Texas markets we've been looking at. And performance results for the top tier product are about what you'd expect, given the metro is dealing with a fairly sizable block of recent completions. At Class A properties, occupancy is a hair under 93%, and rent growth is at 2.5%. More concerning is that the numbers aren't meaningfully better for Class B product, which has been a strong spot for the rest of Texas, and the Class C properties are doing a little worse. And as Greg mentioned earlier, some renter households who were there as recently as 3 years ago have been missing the last couple of years, even though total employment continues to grow.
So looking ahead, and as in these other Texas markets, the new supply tally will be a significant influence. And not much is changing in San Antonio in that regard. We currently have 9,002 units under construction. Of those, 6,482 should finish during 2015. So that new supply number in the coming year is virtually identical to 2014's total. Even if you look at the construction numbers on the submarket level, really not much happening in the overall big picture. The typical leaders in this metro are far north central San Antonio and far northwest San Antonio, and as usual, they are the most active construction areas.
So in terms of the revenue outlook, you have a similar outlook in the economy as from 2014 to 2015. You have a similar story in the supply side from 2014 to 2015. So it's a similar story on occupancy as well. We don't think occupancy is going to move much. We forecast it inching up just a little bit in 2015, getting right above 93%. And the base case for rent change calls for a little bit more of the same, except again, a little bit better with rent growth just a hair above 3%. So Greg, we've talked a lot about Texas past few videos. Any final thoughts on Texas as we wrap it up?
Well, we certainly have focused on the big markets here. I'm going to throw out just a handful of observations about 3 more. We'll start with the Midland-Odessa market, and certainly if we're talking about a trouble caused by the energy sector, that's where you'll actually see it. The majority of the economy is tied to energy in that part of Texas, and things could get ugly very quickly, not just because of that dependence on on oil, but also because production costs are a little bit higher out in West Texas than they are in the South Texas field. So if something's going to shut down in Texas, it's more likely Midland, Odessa than South Texas. Another one to focus on, Corpus Christi. There's certainly some vulnerability there as well. If you look at the major port that is there, it's actually closer to the oil fields than Houston is. So if you're actually going to ship some crude oil rather than refine it first, Corpus Christi tends to be the place that you send it, so some vulnerability there. And then one more for us. Let's talk about the Valley, which is the Brownsville, McAllen area. As we said in San Antonio, that's one where maybe you could actually get a little bit of a bump from people coming from the oil fields back to that metro and getting jobs there. But McAllen and Brownsville are right next to that big South Texas Eagle Ford shale field. So again, that one has the lowest costs and really is the one that is most likely to keep producing. So maybe they don't actually come home.
So, Greg, we've covered a lot of ground in our Texas series. If you missed any of it, you could find it at propertymanagementinsider.com. A special thanks to all of you who've sat through all of these videos on Texas. So let's wrap it up. Until next time, for Greg Willett, I'm Jay Parsons. Thank you for watching Apartment Market Dynamics from NPF Research.
Want more? Go deeper with NPF Research's apartment market reports. From a national level, down to individual metros, to specific neighborhoods, NPF Research has been providing unparalleled apartment market intelligence to the multifamily industry for almost 5 decades. Learn more by contacting us at 877-284-4938 or visit www.npfresearch.com and click on Market Reports.